This is Mohneet Dhir, product specialist at Vanguard UK.
She's kind of a big deal.
And the product she specialises in is everyone's favourite, the LifeStrategy Funds.
They're just phenomenal to watch.
She recently sat down with this guy. His name's Kyle, and he works for Interactive Investor. With the LifeStrategy Funds being 10 years old and the outlook for global markets changing rapidly, understandably, investors and professionals alike are wondering what's next for the LifeStrategy Funds. What do the next 10 years look like for the most popular fund range in the UK? And are Vanguard about to make changes to this fund range? Kyle asks about everything. Fees, the hotly debated home bias, and even questions if the bond allocations are now pointless. Hearing the answers to these questions directly from the horse's mouth will give investors in these funds a better understanding of how to approach them going forwards, and also answer questions like, am I invested in the right fund for my goals? I'll link the interviews in full down below for you, but let's just get on with it, shall we?
LifeStrategy funds have been great performers beating index and active funds within their Morningstar peer group.
That's a bold claim, isn't it? And not just one I want to take on face value. Have Vanguard's LifeStrategy funds beaten all the other competitors when it comes to returns? Mohneet, took me 4 hours to make, I'm going to reuse it. Mohneet was very clear when she said,
within their Morningstar peer group.
Morningstar peer group. What are those? So Morningstar is a financial services company that compiles and provides investment data. If you type the name of any fund into Google, you can bet one of the top searches will be a Morningstar page. It looks like this. One of the ways that Morningstar compares and ranks funds is through peer analysis. All that means is they compare funds to similar funds. So you're getting a comparison that's apples to apples. If I'm shopping for a global index fund, I want to compare the performance of that fund to other similar global index funds. So Morningstar group funds into peer groups that do similar things. Mohneet is saying that the LifeStrategy funds have beaten all other funds in their peer groups. One way to check this without getting really deep into the performance of hundreds of different funds is to use Morningstar's star rating. You can find that by searching the name of the fund, clicking on risk and rating, and you'll see these stars here. Now this star system isn't Morningstar in like some TripAdvisor-esque kind of fashion saying, oh yeah, 5 out of 5, we really like this. It's a score relevant to the other funds in the peer group. So it's not them just scoring this individual fund, it's them saying this is how it's performed versus all of the other similar funds that we've grouped it together with. This definition might help clear things up a little bit. Within each Morningstar category, the top 10% of investments receive 5 stars, the next 22.5, 4 stars, the middle 35%, 3 stars, the next 22.5%, 2 stars, and the bottom 10% receive 1 star. So that means at a glance we can look at these star ratings and get a feel if these funds have performed well relative to their peers in the 10 years that the LifeStrategy funds have been available here in the UK. We're looking for top marks here, 5 out of 5 guys. 20%, 5 stars. Same for the 40. The 60-40 fund, 5 out of 5. And the 80-20 fund, top marks. And then the 100% fund. Oh. Now I think the statement that the LifeStrategy funds have outperformed their peers when you look at them as a collective is true, but the 3 out of 5 on the LifeStrategy 100, which would imply that this fund is middle of the pack when it comes to comparison against its peers. What that means is it's either not produced the same level of returns as other global funds here based in the UK, or maybe it's done that but with more volatility. I bet I know why this is the case.
The range has a bias towards the UK, both the equity allocation and the bond allocation. Could you explain what the thinking was behind that?
The home bias means these funds have a UK focus. 25% of the equity portion of the fund is invested in the UK, meaning allocations to other parts of the world are reduced. More UK means in this case less America. And I don't know if you've heard, but over the last decade, America's been kind of a big deal.
US has outperformed the whole of the rest of the world's stock markets by double.
It's been the best place for investing returns in the last 10 years, so a lean towards the UK and thus a reduction in exposure to the American markets will have hurt the performance of these funds versus a global fund that doesn't have that UK bias. This should apply to all of the LifeStrategy funds really. Maybe the bond allocation in the other ones has dampened that effect and that's why they still score highly. I don't know. I'm just editing this video and saying I don't know isn't good enough. So I took a look at it and I am right. The types of bonds that they add into the LifeStrategy funds have served them well in the last 10 years and meant that the funds have performed well against their peers. But the eagle-eyed of you will have noticed on the Morningstar ratings that those ratings have all dropped in the last 1, 2, 3 years. This is because the bond strategy that Vanguard employs, what's got them here and done so well in the past, is now under a lot of weight from high inflation. There's actually a lot of calls in the medium from professionals to say this type of strategy is now broken and that the LifeStrategy funds need to change in order to accommodate it. We'll get onto that in a minute, but first let's just go back to the home bias. The explanation for the home bias is as follows.
Yeah, so home bias is actually a very interesting topic, and When we initially launched the LifeStrategy Funds, we did some research into investor preference for home buyers. We looked at different dynamics of investing. We looked at this across the globe, not just in the UK. And when we launched the funds, we could see there was, based on our research and based on our sort of client surveys that we did, we could see that there was a strong investor preference as well for having a home bias, as well as our research supporting it. With that in mind, we decided to implement a home bias in the LifeStrategy Funds. So we hold 25% UK exposure on the equity side and 35% on the fixed income side.
That bit there about the home bias is an interesting one, is a little unconvincing to me. It's like, Mohneet sat there going, yeah, we're not too sure, but we did a study and those were the results.
Home bias is actually a very interesting topic.
In truth, I see far more people have an issue with the home bias than people that support it. And I do wonder, if they took that test again, would people still want that home bias now? Would they still want a lean towards the UK? If I had to make a guess, I'd say Vanguard aren't going to change it. And to be honest, I don't think they should either. Because if you want a fairly weighted exposure to a global equity portfolio, then you could just buy VWRL or the FTSE All Cap and be done with it. And if you want to add some bonds, you just add a bond percentage allocation on the side to whatever your preference. So you could add 20% bonds, say. Now, having the UK lean gives them both options on their platform. By removing that, they then do exclude people who do want a UK lean, and there must be some because they've done the study. I would also say though, just to counter this as a broad thought, people buy the LifeStrategy funds because they're an easy off-the-shelf investment. They're aimed really at beginners who don't know what they're doing. None of us know what we're doing, but they really are aimed at beginners. I think it will be more prudent for Vanguard to kind of lead from the front and say, this is the asset allocation that we think will produce the best returns in the long term. I don't want to have a say in what makes up the portfolio because I don't know better than Vanguard. It's like going to the gym to see a personal trainer and the personal trainer going, right, mate, what do you want to do today? And I'd be like, well, I was hoping you would tell me because you're the personal trainer. No, mate. What we're going to do, we're just going to make sure we have a load of fun in here. We're going to do what you want to do. Well, I just want to sit here and eat ice cream. Okay, well, 3 sets of 8 of that then. I mean, that's a terrible example and I'm only messing around. I just would have thought that Vanguard would have led the asset allocation themselves and not look to individuals to say, this is kind of what we want from a product. But at the same time, Vanguard are trying to sell funds, and if they found that people are more likely to invest in a fund that has a UK weighting, that's fine. But I would hope that portfolio construction on the Vanguard platform was led by what they think will produce the highest returns, not what they think will produce the highest amount of sales in terms of people committing to the funds. It's my understanding that the average investor using the Vanguard platform hasn't got a Scooby-Doo what the best thing to put in their portfolio is. That's why they buy index funds in the first place.
What's up, blankety bleep is going on here?
But in regards to this UK allocation, I do agree with Mohneet that the UK probably represents good value and might see investors with this UK lean do better in the next 10 years than they have, say, previously.
And hopefully, if the outlook for the UK, as many economists are predicting, continues to be positive, this home buyer should serve investors well going forward.
But that's more luck than by design, and is a feature of the fact that the UK markets have underperformed, say, the American markets in the previous decade. Now, one thing that is intentional about the makeup and structure of these funds, and one thing that's also been drawn into question, is the bond allocations.
And will become particularly challenged in an environment of higher inflation.
The logic for the bond allocation within a portfolio is simple.
We always ask investors to think about bonds as the defensive element in their multi-asset portfolios, because their role is to make sure that they can buffer off the volatility that equities bring into a multi-asset portfolios. Equities are extremely important as return generators, but you also need bonds to be able to make sure that the volatility doesn't impact your overall return.
A less bumpy ride, but for a lower return. The problem is recently, that just hasn't been happening.
And inflation tends to affect them in a similar way. For both assets, they tend to be hurt by a rise in inflation and helped by a decline in inflation.
The inclusion of bonds in a portfolio is having the opposite effect, because instead of hedging against stocks, while stocks are falling, the bonds are as well. This is leading to questions like this.
Saying that the 60-40, 60% in shares, 40% in bonds portfolio model is outdated.
What is the point in having bonds in your portfolio to reduce volatility when they're doing the complete opposite? Because then you're just reducing your return potential and not seeing any of the benefits.
The equity bond mix is going to be even more important than it has been in recent history, whether that's the last 10 years or the last 30 years. And the reason for that is the next 10, 20 years are going to be different from what we've seen in the last 10 to 20 years. especially in the next 10 years, we're likely to see more uncertainty. Since the global financial recession, we've had record amount of stimulus from central banks, and that's changing now. And what that means is more uncertainty in the market, but also we're recovering post-COVID as a world globally. We've also got highest geopolitical tensions that we've had in a long time. So all of these factors combined actually indicate the need for bonds being even higher going forward than they have been in the past.
What I want to focus on there is Mohneet's response in terms of timelines. She talks about the next 10 years. Yes, it's true that bonds are not currently doing what they should be in people's portfolios. In fact, Bloomberg says they're the most useless they've ever been. But that's right now, in this period of high inflation and uncertainty for markets. I think as investors, we know that we should take a step back and look at the bigger picture often. I want to just look at this graph with you. So it shows the correlation between stocks and bonds. It looks at past data to compare when stocks went left, did bonds go right? Anytime we're below this line, bonds go the opposite way to stocks, but we can see at points, including right now, bonds have moved the same way. And at that point, people question, should I be using bonds? But look at the bigger picture. Over the period, bonds have provided a great hedge against stocks and done their job. But there's a problem here. This data only goes back to 1998. Prior to this, bonds actually were correlated to stocks. When stocks went down, so did bonds. It's actually only in the last couple of decades there's been this negative correlation. So the thing that has meant that Vanguard's funds, the LifeStrategy funds, have outperformed their peers over the last 10 years could be the thing that drags them down over the next 10 years. I watched this great presentation on the relationship of stocks and bonds while researching this, and I've linked it below for you. This could be a whole video by itself, but in short, since 1998, inflation has been kept relatively under control, meaning that stock markets have risen off the back of surprising, in some cases, growth in economies.
Different kinds of economic environments will create different relationships between stocks and bonds themselves.
Now, the argument this presentation puts forward is that if the narrative is one of surprises in inflation, so if inflation data continues to surprise markets, then you see stocks and bonds move in the same way. So the question really is, how long will inflation go on for? And will the narrative over the next decades be one of inflation shocks or growth shocks? Vanguard is sticking to their guns with the bond allocation, which would imply that they feel that inflation will come under control at some point. But if you are wary of bonds and you're looking to reduce volatility in your portfolio, consider this. Where are you going to put it? Gold, crypto, commodities? None of them provide as good a long-term hedge as bonds have traditionally. And whilst they might do that in the short term, there's probably a better hedge right now going on. It's really hard to say what that's going to be leading up to the event. And by the time that it happens, it's already too late. You're putting your seatbelt on after the car's already crashed. With a good investment plan, you don't change it because the winds change direction. It's often the case that at times your investment plan won't be going right. The key thing is consistency and sticking with it. It's like saying, I want my stocks to go up, but they are falling, so I'm just going to give up. We know as investors in the stock market that kind of approach is laughable and the opposite of what you should be doing. Well, the same kind of mentality should be applied to these multi-asset strategies that include bonds and stocks. There's always going to be times in history when nothing works, where everything goes wrong. But that doesn't mean you should deviate from your plan. The important thing here is having a strategy and a goal that you're working towards, and you consistently invest and work towards that goal no matter what happens. Mohneet does say that Vanguard uses a range of bonds in order to diversify further, but the allocation of bonds in a portfolio is always debated. So I guess as an investor, you might ask, which fund should I pick then? Mohneet actually gives an example of how she uses the different allocations in her investing life that may be useful for investors wondering what they should choose when it comes to the LifeStrategy funds.
Myself invest in the LifeStrategy 80% equity fund. I'm actually investing mostly to help my son and to hopefully renovate our house sometime in the future. So I feel that 80% is a good mix for me, given my time horizon, and the 20% bond allocation helps buffer any equity volatility. However, my son, who is 2 years old, I recently opened a junior ISA for him, and he is invested in LifeStrategy 100% equity because he's got a long time to go before he's going to need that money.
Two different goals over two different timelines, so she has two different approaches. She uses the allocation of bonds to reduce the volatility within the portfolio, and just because that allocation of bonds isn't working as it should right now, she's not changing that strategy, and she's still working towards those medium to long-term goals. Right now it's time to discuss the juicy stuff. Fees, performance, and the likelihood of them adding other asset classes to the funds. Let's start with the fees. The question from Kyle was simple.
How big do the funds need to become for the charge to be reduced further?
Mohneet then came back with this response.
So since we launched the funds around 10 years ago, just over 10 years ago, we have cut fees multiple times. And every time that we've been able to lower fees, we're at a certain point where we think that the funds are scalable enough for us to be able to cut fees. And we believe that we're not at that point yet. Hopefully we get there soon if investors keep having faith in us.
So it would seem that Vanguard are open to reducing the fees on these funds, and they are at the top end of the range in terms of the fees on the Vanguard platform. Everything on the Vanguard platform is cheap, but these are a more expensive, cheap product on that platform. It all comes down to what they're saying, scale. So the funds need to get to a certain size before they'll reduce the fees. What that size is, I don't know. But the LifeStrategy funds have seen significant amounts of cash flow into them, as this chart shows, and they are getting bigger. So hopefully we hit that threshold soon. Right, the next point is on different asset classes.
So it's going to be even more important to be incredibly diversified.
So important is diversification to the LifeStrategy funds and Vanguard's whole approach, really, that Mohneet says diversification 7 times in a 9-minute interview.
Diversification. It's important to always come back to the point of diversification.
So it makes sense that Kyle would then ask this question.
And has Vanguard considered or is considering now adding alternative assets such as property and infrastructure in order to give some additional diversification as well as having equities and bonds?
Mohneet's answer is essentially no. We've done the research, we've looked at it, and our understanding is that bonds and stocks are enough, and we don't need to add other asset allocations like property into the mix at this stage. Now, I will never question the quality of the research that Vanguard produces, but I will say there's a lot of investors in the UK that would love to see a REIT added to the Vanguard UK platform, and for many investors, the lack of a REIT is a bit of an issue. But there is something that Mohneet did not mention. The LifeStrategy funds actually have an exposure to property built into them through their owning of REITs that are listed on global stock markets. In the same way, you could argue there is an exposure to commodities through them purchasing mining companies, so it's an indirect exposure in that way. But the REIT thing is a definite exposure to property. So there is that exposure, there is that allocation towards those assets built into the funds through the holdings that they have. Here's a breakdown of the sector allocation in the LifeStrategy 20 funds versus some competitors. There's around 3 to 4% property exposure in the fund. Not as high as some people might like, but they're not completely sidestepping these sectors. You are getting that exposure as part of the funds. Right, let's get on to the final thing here, and that's the performance. Kyle asked quite directly, do you think the funds will continue to perform well considering the fact the market returns are expected to be less in the future?
So in the years to come, do you expect the fund range to be as successful as it has been over the past decade?
So we're going into an extremely difficult time for markets, for investors, for everyone really, whether that's investing or personal life, given where inflation is. We really hope that the LifeStrategy funds can provide investors with the same sort of return, sustainability and returns that we've provided over the last 10 years. In fact, we're positive that they will, given that the asset allocation is strategic, so we don't make market calls. We're not trying to time the market, which is becoming more and more difficult to do given how much uncertainty and moving factors there are. And central banks are becoming more unpredictable as well in the way that they do things. So we're hoping that the strategic asset allocation will play its part over the future as well, as it has done over the last 10 years. Being strategic allows you to really hold your positions and ride through market turbulence and market storms.
Being strategic in your asset allocation really allows you to hold your positions and ride through market conditions. To me, that bit is crucial. When everything is going wrong, stocks are down and the protection bonds promised is not happening, it can be really tempting to question the strategy and think, right, we need to make changes here. But coming into this, honestly, if Vanguard had said we're going to change things, I would have been really surprised. I think it's heavily reassuring that Vanguard are leaving these funds in the main untouched. Fee reductions aside, of course, because lower fees are always a good thing. But if Vanguard came out and said, you know what, we're going to change the asset allocation, we're going to reduce the bonds in the portfolio, we're going to let you invest in property through a REIT as well, and we're also going to change the name of the funds, I think investors would be really worried. Or they should be at least. These funds represent a common sense approach to long-term investing, where the parameters of that are easily defined and there is a clear strategy around asset allocation based on research over decades of data. In a collection of funds called the LifeStrategy Funds, you would hope that the strategy they employ is suitable for life. And while it might be human nature to want to tweak things and adjust them according to external factors, I think Mohneet's message and Vanguard's of this is how the funds are and this is how the funds are going to stay is exactly what investors in these funds should want to hear. Thanks, Mohneet.